Hey everyone, this is Paul with 360 Stocks, and today we're going to be studying some charts on the Nasdaq Composite Index, Meta. We're going to look at charts of Amazon, Netflix, Google. We are going to look at the Federal Reserve's battle with inflation. So let's get started. Here we have in front of us a Nasdaq Composite 1 week chart, and so each candle here represents 1 week of time, and we have moving averages. With in red is the 50-week moving average. In blue here we have a 200-week moving average. Our little band in here that is shown in green is the 20-week moving average and an 8-week moving average here in yellow. And we see that prior to 2022, the Nasdaq was trending above these averages, the 50 and the 200, and then beginning in 2022, prices began to slide below the 50-week moving average, testing this line here and here before its current landing at its current location in October. And the last day of October, we're going into November, and we are below the 50 and the 200-week moving average for the Nasdaq. Now let's go over here and look at Meta, and we start with a bigger picture of Meta on the weekly charts, and we see that Meta also towards the end of the year was above the 50-week moving average, and now prices have cascaded below the 200 and the 50. And let's go over to Amazon, and we see Amazon was above the 50-week moving average here towards the end of the year, and now prices are below the 50 and the 200. And let's go on over to Netflix, where prices were above the 50 in December, and now prices are below the 50 and the 200. And one last chart here to look at, and we have Google, which was above the 50 in the end of December, and now it is below the 50-week moving average and the 200-week moving average as of today. If you're enjoying this content, I just ask that you click the like button. So what does all of this have in common? Well, towards the end of the calendar year here in 2021, the Federal Reserve announced that they were going to start raising interest rates because the PCE price index that they follow was rising higher than their target value of inflation at 2%. So there is a famed investor by the name of Martin Zweig who said, "Don't fight the Fed," and let's just look at that a little bit. So "don't fight the Fed" was an old mantra, and we see that we have a phrase, "don't fight the Fed," that was coined by Martin Zweig in 1970. He was a famed investor, and he explained that there is a strong correlation between Federal Reserve policy and the direction of the stock market. So it's a simple idea, and it goes something like this: when Federal Reserve monetary policy is loose, markets tend to move higher, and investors' risk is limited. So let's go on and look a little bit more about this battle between the Federal Reserve and this issue of their goal of controlling prices. So the Federal Reserve System has a policy document that they issued here in January of 2024, and they're reaffirming a previous policy. And they say the Federal Reserve, FOMC, is firmly committed to its statutory mandate from Congress of promoting maximum employment, stable prices, and moderate long-term interest rates. Okay, that's all good. And now we have the committee reaffirms its judgment that inflation at 2%, measured by the annual change in the price index for none other than personal consumption expenditures, is the most consistent over the long run. So let's look at this personal consumption expenditures. Here we have the core PCE index. The core PCE index is defined by personal consumption expenditures, excluding food and energy, and it measures prices of consumers' goods and services without food and energy. Okay, now let's look at some historical data for this index. So, kind of back here in 2019, we were focusing over here on the right-hand side of this chart. 2018, we saw that prices were all running below that trigger of 2% that we read about in that policy manual. And then we come over here, and right about here in March of 2021, prices popped above 2% for the first time. And then in April, they went to 3%. And then here we are by October of 2021, a year ago today, at 4.3%. And then towards the end of the year, the Federal Reserve announced, hey, we're kind of concerned about this PCE, and in March, we might raise the rates 0.25%. The markets took that and started sliding, in my opinion. So they caught wind that the Federal Reserve was going to begin its tightening of monetary policy, and that's where we get back to Mr. Zweig's opinion of don't fight the Fed. Okay, since the Federal Reserve announced that policy, we see these declines in prices. That is the correlation that I'm trying to describe here in the video. Now, I want to make a disclaimer here, is I am not providing financial advice. I'm not a financial advisor. This is just for entertainment purposes only. Okay, so why are we talking about this? Well, let's think about when the Fed had this 2% inflation here in March of 2021, but it took them a full 12 months before they took action and decided to raise interest rates 0.25 point. So this was really a 12-month lag from the time when their first change in the target. And now we see, what did they do in 2021 to present? Well, in 2022, 1 year after this started, they raised 0.25 basis points. Then they raised 50 basis points, 75 basis points, 75 basis points, 75 basis points. In other words, 0.25% increase in rates, as most people describe it. Since they've been doing that aggressive stance of raising interest rates, the stock market has reacted by trading lower, and that is definitely correlated with the ability of businesses to function and borrow money, and the cost of doing business and the available credit to expand and grow your business based on the availability of debt and the cost of debt and its effect on profitability. Well, that's going to take care of this video. If you enjoyed this content, please click the subscribe button. Right next to the subscribe button is a bell. You'll be notified when these videos get sent. There'll be a notification sent to you immediately when the video is created. So thanks again, and we'll look forward to seeing you in the next